You want to make yourself useless. So just like we're trying to run at this number, we look at all the things that require you on a day-to-day in order to be executed. Even if you're delegating them down, like where's the decision making? How much of it are you doing? How much of it you are deciding whether it gets done or not? And how can we start to break that stuff, empower the team? If you want to increase enterprise value, it's going to be making yourself less reliant. But the point is the upfront money and the hassle and all that kind of stuff and the value from day one is going to really be predicated on your ability not to be the hero of the entire company.
For our listeners today, you get Adam and I. I am Tom Wadelton. I am a virtual CFO at Summit Virtual CFO by Anders. Adam Hale is my co-host. Adam, welcome to today's program.
Yeah, thanks, Tom.
And I should have said Adam runs our BCFO division, and we've worked together for a long time. Adam, today we're going to talk about something that we talk a lot with our clients about: preparing a business to sell, and then also selling the business. So I guess starting out of the gate, help me when you first start working with a client, helping them kind of think through what could this sale look like and just the beginning part.
Yeah, I mean, I think the thing that kind of throws clients off whenever we work with them, because we're always focused on, I always say we're like financial Sherpas and guides. Well, if I'm going to guide you somewhere, I need to know where you're going, right?
Yep.
And so we typically start off telling clients, we want you to build to sell. And, you know, I really don't care, Tom, if you want to pass this thing to your great grandkids. What I'm really trying to get to is like, our purpose is really to make this thing really turnkey, if you will. And so if you think about it in that context, then you will be built to sell. And so whenever we're sitting down with clients and we're asking them, hey, what does the next 3 to 5 years look like? Some clients are really good about being able to say, hey, I want to do this. I want to do that. I want to sell. I want to do these kind of things. And I say to some people, I'm like, well, okay, I had to change this number because of inflation. Yeah. But, you know, if I gave you $20 million today, you know, I used to say $10 million, but if I gave you $20 million today, what would you do? And a lot of times the answer is like, well, hell, I would just pack things up and I'd be good if I got $20 million for this thing. Yeah. And it's like, okay, cool. Well, then let's talk about that. And so, so anyway, I know we're going to dive more into like the folks that decide to go down that route. But just from the very onset of all of our advisory conversations, this is like a key component of it.
Yeah. And I think that's so important because I know one of the reasons that you came up with that answer is because people say they don't know. And sometimes it's, Adam, I'm dealing with just trying to hold my business together for the next 2 weeks because things are just crazy right now. And so I'm not thinking about that. But I think what owners can find is that could be your mentality for 18 months in a row, that you're always feeling like I'm just putting out fires constantly. So unless someone helps you step back and think about that, then you're able to say, well, I've got this direction and we're trying, you know, that 20 million, all of a sudden I'm like, hey, that sounds really good. And in 10 years, that's what I want. I've given you a really good tool to then say, okay, what would it look like in 10 years if this was to get me the most money for my business if I'm the owner?
That's 100% it. I mean, they get caught up in the day-to-day whirlwind, and our job is to help provide, you know, strategic focus and be intentional about growing the business or making the business more efficient. And so in order to do that, again, if we're going to be the Sherpa and we're going to ride alongside of them, I need to know the destination. So even if the destination changes on me, I don't really care, you know, and the process is kind of the same no matter what you're going to do in terms of best practices. But once we do that, or somebody says, no, I would love to sell the business in 3 years. I think that the next thing is then asking them, how much do you want for it? Right? Like that's the very next question out of my mouth. And the problem is most people don't know. They're like, well, what's it worth? And they're asking me, and I haven't even seen their financials yet. Yes. And I'm like, well, don't worry about what it's worth today. What I need to know is what it's worth to you in order to sell. And then whenever they don't know that answer, a lot of times, Tom, what I do is I ask them, I go, do you have a financial advisor? And sometimes the answer is no, they don't have anybody. And I'm like, okay, well, then we need to solve this problem because you need to do some planning. And other times they do have somebody that they just don't really think about it in that context. They're more worried about like what their investments are. Maybe they just have their 401k because their number one asset's the business. And they've just been dumping money into this 401k account. I'm like, well, here's what I want you to do. And I have like a really simple formula where I can walk through and show them like they can plug in their social security benefits, you know, that they can look up really quick. I'll give them an assumed tax rate, you know, all that kind of stuff. I need to know how much money you need per month to live off of and feel completely comfortable. Take the vacations you want, assume you're always going to be leasing or buying a car,
Yep.
hopefully the house is paid off, whatever those things are. I'm like, what is that monthly safety net that you need? You need to then go to your financial, and then I can back into what I think the holistic number is. I still just use kind of the 4% rule. You should be able to draw down 4% of whatever your investment is and not really touch it. But I'm like, go to your financial advisor, have these conversations, make sure that you're, take into account what investments you already have, and then figure out what that number is. Cause that's how we're going to back into what you absolutely must have from the business.
Yeah, I think that's great. And I also like the way you're thinking about that, because if you use the $20 million number, if you gave me that, so if that was my number, you're starting to poke around that with those kind of questions you're asking to find out, is that a thoughtful number or is that just maybe a vanity number? And 20 million seems really high. Maybe I'd say 3 million. And then your exercise could be really good. Like, okay, if you're going to retire at that on 3 million, can you live the life that you want on that? And maybe I have enough in savings and things that's reasonable, but it would be great if your analysis comes back and says you're well short of your monthly goal if you get $3 million for the business. Let's talk about, could we get the business worth, it needs to be sell for, say, 8 million to get the numbers that you're wanting. And then we can have the conversation what we do with our business.
Yeah. And then I think that from there, the next step is like, they come back and they say, this is the number I need. This is my delta. This is the gap that I need to get from the business. Then we can go in once we've looked at the financials. And don't get me wrong, like there's valuation experts out there that can do all kinds of stuff. I mean, if you're seriously consider selling the business, we might also then want to talk to, depending on the size of your EBITDA, either a broker or an investment banker. And we can kind of talk about the difference between the two of those roles in terms of selling your business. But at the end of the day, it all comes down to how much cash is the business throwing off if I left, you know what I mean? So if my salary is weird, if it's too low or if it's too high, I'm taking a bunch of personal stuff out, whatever. How much cash is the business going to throw off and how fast can I get my money back? I mean, that's what most investors are going to want. So you always hear this like multiple of EBITDA. Basically, all that is saying how much cash do you generate and how much debt can I service based off of that? And, the ranges can be all over the place, but realistically, the ranges are anywhere from 3 at the very low end if you're not very turnkey or you have a very like low recurring model kind of a business. And they can be 7 or 8 times, so 3 to 8 is a big range. I would say on average, you're looking at 4 to 6, typically. Yep. I'm not saying that there aren't some industries where you're going to get a 10 multiple, you're going to get a 12, and we can diagnose that later. But the reality is, if you're throwing off $500,000 in adjusted EBITDA, net earnings from the business, and you need $8 million and you're going to get 5 times 500,000, you're at 2.5. So we got to do a couple things. One, we got to get more aggressive with your current sales. So if we're not going to sell for 3 to 5 years, so we're going to tackle this thing 2 ways. One, we can try to grow the business and tackle it from like an EBITDA perspective, like the sales price, but we can also get really aggressive with what we're saving at the same time and then bring down that need. So maybe over the course of 3 to 5 years, we're going from 8 million down to 5, and we're like, great. And then we've been able to close the gap between, what an expected sales price would be and ultimately, what you're going to need. So now it's $5 million and we've grown the business to the point where it's worth $5 million.
Yeah. And I love that because now we've got targets that we're going for, right? I've got your sell price. Let's make an assumption. You can do the rough assumption, like you said, for EBITDA, and how do we close that gap? And this is probably a good time then, if you look at what your current EBITDA is, you could look at some industry standards, right? And we use a report called Vertical IQ is one, Profit Sense does one. There are several those say in your industry, what's reasonable. And if for this made up company, if you find out they're not nearly as profitable as the industry, now you've got some things to look at that. Maybe we should talk a little bit about lifestyle business versus more professional, ready for sale business, right? Because you could probably look and say, if you've been running for this a long time and this has supported your lifestyle, you can take the amount of money you want each year and you've got this comfortable life. You may say, do you want to convert this for a ready for sale business? That could be things like maybe your team is not as productive or a little bit bigger than what you need them to be. Makes you comfortable, but maybe that's one of the things to say as we grow. If I'm going to hit these benchmarks, maybe that team doesn't grow with it, and they need to be more productive. And this is run more like an industry-wide business.
Yeah, those are tough conversations, and those are hard to kind of grow out of. Those are typically tougher situations to outrun. But yeah, we absolutely run into that on a quasi regular basis, whether it's just, oversharing with profits. You got to kind of take that into consideration too. Like how much of that stuff goes with the company and how much of it doesn't. And I think that kind of speaks back to, like if you're trying to, so this is like more of the accounting nerdy kind of stuff, but when you go to sell, you need to create this VDR, virtual data room, where you're going to put all kinds of things. So whether it's a broker or an investment banker that you're going to, they're going to say, here's my checklist of everything we need. What I think is the most important thing that you can do today, if you think you're going to sell, is storytell. Meaning they're going to want, by month, they're going to want a 3-year P&L. They might want a 5-year P&L, but typically 3 years is good enough. The problem is Tom, you don't remember what you did in August of 23 and why the income spiked or why those expenses spiked. So the best thing that you can do today, and what we talk to our clients about, is what we want to do is we want to start exporting that into a VDR kind of format, so it's going to be, here's the Excel doc, here's your net income. And then we're going to add back, we're going to do the EBITDA add back. We're going to and then we're going to do all the normalizations. So if there's any unusual items, we remember that. And if we're doing it right now, if we're doing March of 2025, then we know, oh yeah, that weird thing happened, or I paid out that bonus, or I had this thing happen.
Yep.
And so you go ahead and you do the add back, the normalization, because we want people not to worry about that's ever going to happen again. We want money for that. And then the other thing is we can make notes. So we can just leave ourselves breadcrumbs every single month, and you stack those things up. It's really, really cool whenever you get to the point where you're getting ready to sell and you have that stuff dialed in.
I really like that idea. Those questions come up. The obvious things people could be thinking of is when we went through the pandemic, people had things like PPP loan forgiveness and employee retention tax credit. Those are obvious, but you look at this, we often put that in other income. And so you see this really profitable time that you need to note those things. Some of those are easy, but it's also kind of a pain to go back and look at the history. But then you get smaller ones that just get forgotten if you don't put in that story. And
exactly.
You're like, some tough time, but we did some bad debt, and I can tell you this story. But after that, 3 years later, you're looking, I just got a number and some journal entry that wasn't documented well. And
it can cost you millions in your sales price because you're not able to justify the adjustment. And so that's huge. And the other thing is too, not that GAAP is 100% adoption to GAAP is not always the easiest thing to do or most functional for a lot of our clients, depending upon the industry. But really making sure that if there is a RevRec situation, you've got RevRec dialed in. If there's prepaids or accruals that need to be done for like payroll and things like that. PTO is a big one that, like, whenever you go to sell, nobody ever does the accrued payroll or PTO stuff. Yep. Like, just go ahead and bite the bullet, put them into your month-end close schedule, get that stuff dialed in. You do those kind of things. And I assure you, none of your clients pre-you are doing any of that stuff. So if you do that, you're setting them up for eventually being able to sell. And even if they don't sell, you've made their business from a financial perspective more turnkey in terms of making sure everything's pretty high and tight.
Yeah, I think that's great. And you also are avoiding a really uncomfortable conversation if someone doesn't have, say you've got a large PTO accrual or RevRec is not done on an accrual basis. If someone offers an EBITDA price based on that, and then after it's corrected, they're adjusting the price down significantly, you both set your owner up wrong, but it's also a pretty uncomfortable conversation where you could see them saying, you cost me $500,000. The reality is the business was worth what it is, but we didn't represent it correctly.
Right. 100%.
I think one of the big things that we've talked to brokers who have said the same thing, the dependency on the owner. And one of the big things I think we have seen is the owner's going to step away after they sell, and what happens to the business. And you've got a couple big things, but one of the big ones is all the sales, the rainmaking completely depend on that one person? And if that's the case, you've got a couple years to say, we need to get away from that, because someone doesn't want to buy a business and say, but when Adam walks away, everyone knows he's the one who brings in all the money, has all the contacts, and the business falls apart. do you agree with that? And then I'm curious, are there some others where when you look at the business where you're like, hey, owner, when you step away, here are some things we need to shore up so that the business can operate when you're gone?
Oh, it's everything. It's top down. Sales is a huge one because that's usually the last position that owners give away. So just in the progression of
Yes.
ownership, they're wearing all these hats. They're the CFO, the COO, and the director of sales. You know what I mean? Like they're the CMO, whatever that is, if it's sales, BD, or even marketing. And what you'll see is they'll shed marketing pretty quick because that's a technical kind of ability need. But generally, what we see, especially in service-based businesses, is the first role that they'll bring in-house is the COO or director of operations. Sometimes it's just an office manager, whatever that is, like some of the administrative blocking and tackling, they'll take that off first. And then as they grow past, $1.5 million or $2 million in service-based revenue, then they're going to bring in somebody like us. And then they're going to start parting out the financials. They get to $3 to $5 million in a service-based business. The owner is still a lot of times the BD person. It's not until they get closer to $10 million that they finally let go of that last piece. And then once you've gotten to that stage, you should have all those pieces in place. And to your point, you want to make yourself useless. So just like we're trying to run at this number, we look at all the things that require you on a day-to-day in order to be executed. Even if you're delegating them down, like where's the decision making? How much of it are you doing? How much of it you are deciding whether it gets done or not? And how can we start to break that stuff, empower the team? Because to your point, if you want to increase enterprise value, it's going to be making yourself less reliant. That doesn't mean that an owner, that a buyer won't want you to stay on for 6 months, 12 months, 2 years, whatever that is, especially if there's some kind of contingency buyout in place, some kind of earnout. You might be around for 2 years. But the point is the upfront money and the hassle and all that kind of stuff and the value from day one is going to really be predicated on your ability not to be the hero of the entire company.
Yep. And that can be challenging to coach people through. But I think if they realize, it's money on the line and think of it from if you were buying this business, how would you look at it? I think that's really important.
Yeah. And we did that with our own business. Like Jody's completely worthless.
Yes.
And my goal was to make him worthless first and then myself. You know what I mean? Sure. And so, and I feel like we've succeeded in that. We have a really strong leadership team that if Jody and I disappeared tomorrow, it operates on its own. I mean, that doesn't mean that we don't functionally do things, but I'm saying there are people on the team capable of stepping into those roles and doing those things and handling those decisions.
Yeah. Yeah. As I think of like prospect calls and the selling, since that was the example you brought up first, you got several people. I mean, all of our CFOs know how to price things. Many of us, I think most of us are very comfortable. If you were to say, I've got this call, I can't make it. Can you make it? Someone steps in that should say, we see it. I mean, Jody's at a conference and can't do those things. You're gone and can't do those things for a time frame. And we continue to operate that way. So that's a good example.
Yeah.
So then so we've said you got this long-term plan. We do a multi-year forecast. I think one of the things that we need to do as advisors, and sometimes we can get caught up in the day-to-day also, is making sure we're stepping back with the owner and saying, occasionally, are we on track for that long-term goal? We set in place this plan to be this big in EBITDA, this much growth. And so at least annually is a great time, but a little more frequently to say, if we're exceeding that, do we increase our goals? Or if we're missing that, what do we need to do to get ourselves back onto that track? Because at the moment, when we look ahead 5 years, maybe we're not growing as much as we think so. But now we've got the tools in place to know where we're trying to go.
I think the most important part of that conversation, which I think gets lost on a lot of financial people, and where you can really become a good advisor and push your clients to change, is that, and I say this to my clients just tongue in cheek all the time, I can change whatever number you want me to on the forecast.
Sure.
You're never going to meet a forecast you don't like.
Right.
But my redirect is always whenever I see we're missing a metric or we're missing it, we're missing on a certain part of the thing. And we go, okay, well, we just need to do better. My question always back to them is, what are you functionally going to change, either operationally or from a sales perspective, whatever that is? Let's talk through that, because what we're doing today it's just not magically going to work tomorrow. So even if what we do doesn't work. It doesn't matter, but let's get
Mhm.
intentional around solutioning how we're going to make that change in the P&L. Again, I'm not the COO of their company. You know what
Yep.
I mean? I'm not the operations person. I'm not the BD director, but I am the financial person. And so again, I can just call out the fact that, Tom, you stink and you're missing your number. Good luck. You just need to do better. And I can continue to parrot that month after month and say, do better, do better, do better. But I think from an advisory standpoint, where you can be super helpful from as the CFO for the client, is you come in and you say, okay, team, what are we going to do? Like, let's really think about why we're missing these. Is it because of market? Is it because of this? Is it because of that? Do we need to get it from somewhere else? Do we need to cut cost here? What do we need to do functionally to hit this? And what are we going to change?
Yeah. I think that is excellent, Adam. And the two things that are going through my mind when you're describing that, when I think of my clients, one is when you do the annual planning and next year they tell me that gross margin's going to get better, like by 2 percentage points. And so that can be a great point to saying, if you do that for most of our businesses, that throws a lot more profit to the bottom line. And so it's great to say, okay, if this year we were at 46%, what are we going to do that gets us to 48%? And let's talk about pricing changes, or if it's service-based, are people working more hours, or where did you have this waste last year? The other I think of is people saying they're going to grow by a certain amount. So if I get excited about my top line and say, I'm going to grow by 20% next year. And you've talked before about breaking it into the non-financial metrics to say, okay, let's break down how that happens, because it's pretty easy to put a number up there and feel good about, top line. Now I can say I'm a $10 million business or something that gets me excited, but that's a great area to then say, okay, how does that happen?
Oh, 100%. I just picked up a client the other day and they showed me their 3 to 5 year forecast because they want to sell. And it goes from 15 million to 25 million. By the time they get to the end of 3 years, I think it's at $46 million.
Wow.
And my first question was like, cool, how? You know
Perfect.
what I mean? What do you, in whenever I look at their income statement, it was one line item. And I'm like,
Okay.
not super helpful. And I'm like, and then what are the day-to-day activities? What are the lead indicators? So the most important thing whenever you're trying to break down revenue and how you're going to change and impact things, always think about things as lead and lag indicators. The balance sheet is a lag indicator of the income statement, but the income statement has activities that precede that don't show up on our financials. And I still think those are our responsibility to track, understand, make sure sales team understands them, make sure operations understand them. So if you break down those different revenue streams and you go, cool, so how are you going to get 10 more of these? And then they're like, well, we're going to get 10 more of them. Then I'm like, well, how big is the market share in that? What is the opportunity to get 10 more? What activities are you going to do to get? That's where I'm saying, like, as an advisor, that's your opportunity to challenge. Again, I don't know the answer.
Right.
They probably
Right.
do. The problem is
Sure.
they don't think about the answer. They just kind of keep on keeping on. And then they get frustrated. Like, I can't hit Tom's dumbass number that he put on this P&L. And it's like on this forecast. And I'm like, one, that's your number. Two, I need you to explain to me what's going to change and how that's going to be different. And so if you do that and you run that exercise, again, the clients have the answers. That's why we're guides. You know what I mean? And so, but we're just challenging the status quo, how they're doing things, and just making sure that we can help them get intentional with the desired destination.
Yeah. And hopefully they discover something that lets them hit that number. And along the way, you found things to measure that they say, I'm going to get 6 new customers and that's where it's going to come from. I've got something I can measure now. And when are you going to get those? And can I start saying, have you picked up your first, second, third?
What are you doing today that's just going to magically make 6 more happen? Like, what are you going to do differently? And again, I don't know the answer to that. I really don't care what the answer is to it, other than give me something. I want to watch you think through that process, and then let's run at it for 3 months. And we might determine that wasn't a good idea either. Maybe the reality is we can't impact that number. You know what I mean? So maybe we need to move our focus, our intentionality to another number, or maybe another opportunity came up, whatever those things are. But regardless, everything's not within our control. But if you're doing destination planning, understanding those lead indicator activities and just kind of making people think about them, it'll become, a muscle memory for them, and they'll start. I can't explain it, but you write it down on paper and you push them towards those changes, you'll get there. Another example is like a service-based business. The first thing to do is like, Tom, you're 20 billable hours a week. oh, to make my numbers better, Tom needs to be 30 billable hours a week. So my first question is, so Tom's usually just like checked out for those extra 10 hours, not really doing
Right.
anything. Like, why are we
Yeah.
paying him again? And they're like,
Uh-huh.
well, no, I mean, he's doing this, he's doing that. And I'm like, okay, so functionally, I want to know how you're going to change your sales process to incorporate those 10 hours that he's doing stuff, but maybe necessarily we're not billing for, and that we can realize, because the realization is the other thing. Because especially in service-based models, it's usually not about changing your price. It's usually about making sure you're getting the price that you're charging. So having those kind of conversations, and just like, again, me functionally going back to the sales team and saying, what are you going to change in your sales process that makes Tom's other 10 hours billable? Then I go to the operations people. What are you going to tell Tom to do differently in his day in order to make sure those activities can be picked up from what the marketing team or the sales team do? And then they're all like, oh, well, and then they have good conversations. They come up with a solution, and I see movement in my P&L. But if I don't facilitate that conversation, they just go, okay, yeah, works for me. Yeah, I love that bottom line. Yeah, hell, give Adam 10 extra hours and add 10 to Mike. And then all of a sudden people are like, oh, okay. Like I said, that's the whole point. You haven't met a forecast you don't like.
Right. Yeah, that's a great example. What if we shift a little bit then? And I'd love to tell you, I talked to a friend recently about actually selling his business. So we did a lot of preparation. Now I've got a business ready to sell, but he wants to sell and just wanted to understand from me what that might look like. So just a quick backstory. Dave is a friend of mine, and he's got a construction company, does some high-end like house remodel stuff. And we go skiing each year with a large group. And for the past 3 years, Adam, he said, hey, this is what I want to do. I'd love to talk to you. I'm like, great, let's sit down. We'll sit down, have dinner, and we'll talk about this. Well, big surprise. The first 2 years, we never actually sat down with just the two of us where it felt comfortable. So this year we were skiing together. I said, hey, for the next 3 chairlifts or however long it takes, let's just talk about it on the way up. We've got like 10 minutes each time. And so I went through first and talked about what he thought he would want to do as sell. He was preparing a successor. So like what that would look like. Then we talked about what a typical structure would be that I would recommend, and then the things I wouldn't do. So I'd love to tell you what I told him, and then you can tell me what you would have added, or tell me that I need to go back and tell him, hey, I was completely wrong on this. So first chairlift, we're going up. I'm like, so when you think of selling your business, sort of what's important to you? And he was saying he's built a culture that's really important. He wants the company to run the way he ran it. And Matt is a 34-year-old guy who worked for him, wanted to go leave and do his own business. So he did. Now has come back, but wants to run a business. And so Dave's like, I would love Matt to be my successor, own this business or run it going forward. And that's going to happen in 2 or 3 years. So we talked a little bit about that. I like the idea. We talked about Matt and would he really do it? What skills? What should Dave have to teach him? And then I also shared with him, like, the alternative is another company comes in and buys him and what that might look like. And we talked a little private equity, although he's not quite big enough probably for that. But we also talked about, would another construction company want to buy you who maybe does custom homes, but they think this rehab is good, or geographic kind of things. So that was the beginning. As we got off the chair, it's like, okay, Matt's my guy. This is my succession stuff. What would you add or maybe reinforce anything about that part of it?
Motivation matters, because that's going to impact timing. That's going to impact, your willingness to accept a different purchase price or different terms, those kind of things. Again, number matters too. What I always just caution people about is just expect less whenever you sell internally. I would say, one, expect less. And this isn't an absolute by any means, but I would also say, expect the seller finance a good chunk, if not more, that kind of a thing, if you're going internally. So those are just kind of the realities of internal sales. And to your point, just to kind of back up, because we talked about brokers versus investment bankers, in terms of the people helping to facilitate sales. Whenever you're an internal sale, you're really just selling to Tom. So you're not really taking it to market and shopping it to see who can give you the best price. And best price doesn't mean that that's who you're going to choose. You might find somebody that's like second best price, but culturally it aligns better with who you want to sell to, that kind of a thing. But whenever you're thinking about the difference between whether or not you want to bring in a broker or a investment banker in those situations, there's a lot of reasons to do that, especially if you're going to take it to market. Because just like trying to sell your own house, you don't want to show your own house. You don't want to market your own house. And the reality is you're trying to save your 3 to 5% whenever you're 6%, whenever you're trying to sell your own house. But the reality is you're going to lose that and then some on the sales price almost every time. If you find a realtor, and in this case, the realtor is the broker or the investment banker, that's the reality of it. Now, the difference is that if your buddy is sub $1 million in EBITDA, the reality is that he's probably going to live in the broker world. Like, let's say he doesn't have an internal sale opportunity and he wants to take it out. Investment bankers, they'll spin out to, whether it's private equity or they'll look at family offices. They have a wide variety. They have a huge net, and some of them global. You would be surprised who would want to come in and buy your hometown construction company is from Norway. It's that strange. But they typically don't want to really talk to anybody. I mean, the starting point might be $1 million in EBITDA, but the reality is they want $2 to $3 million in EBITDA. Yeah. And if you're going private equity, that's kind of a starting point for them. And then whenever you get to 5 million, you're kind of sitting in the driver's seat. $5 million in EBITDA, 10 million, you can basically sell to anybody, and you're gonna. And the higher the EBITDA matters, because obviously the multiple, you're saying, hey, like 5 times a bigger number is always going to be better. But your opportunity to get a bigger multiple, in addition to it multiplying and being higher, is there the bigger that you can get that EBITDA. So whenever you're dealing with sub $1 million, and there's even brokers out there, I told you, like, investment bankers don't really want to get involved until $2 to $3 million. There's a lot of higher end brokers, like national ones, that only really want to work with people with like $1 million or $2 million. And then you'll get some smaller brokers, sub $1 million. So, but it's always, in my opinion, if you're going to go to market, it's always best to, if possible, go to an investment banker. They're going to get you your highest and best price. But if you're too small, go to a good broker. Make sure you vet them out. They'll put together their sim deck, which is their pitch deck out to the world. They'll vet all the people. They'll turn them on each other to make sure that you get the best price, and help you think through all those kind of things. So for your buddy specifically, though, if he's dead set on doing internal, my only caveat there would be like, okay, cool, you're good with a seller note. This isn't going to be like an 80-20 deal. Luckily for him, the other thing is whenever you're not trying to maximize purchase price, you don't usually have to worry about earnouts. So the difference between like an earnout and a buyout is, because those are terms that always get thrown out, is like, let's say he values his company at $5 million. If that's a stretch to get there, a retail buyer or a strategic, somebody that's in your space that's wanting to buy your business, might say, cool, I'll give you $3 million in cash. I'll give you $1 million buyout over 5 years or whatever. You're going to sell or finance that part of the note. And then there's going to be this contingency piece, which is the earnout. So if it's an earnout, it's contingency based. So it's, you hit this bogey and I'll give you this. You don't hit this bogey, I don't give you anything. There's a lot of times a waterfall to that. So there's the cash in hand, there's the seller finance piece, which is a buyout. And then there's the earnout, which is completely contingency. So your guy. So I've walked into situations where Matt calls me up and says, hey, I need you to be my accountant and CFO and help me do this. And then I look at the purchase price and I'm like, bro, you bought it for what? So it's like you just got, like, the owner thought it was worth $5 million, but it could only service $3 million. Well, but owner was awesome and they're seller financing the whole thing. Yeah, because it's not financeable. You know what I mean? No banker in the world would allow you to buy this thing for $5 million. That's part of the problem. So no, he didn't do you a salad by seller financing the whole thing because it's out of reach. So again, even if you're the seller, you want to make sure that it's within the realm of possibility, because the last thing you want is a note that's unserviceable, that you're always kind of, doesn't mean that things won't change. That's the risk you run, also being the bank in those situations.
Yeah. That perfect. Okay. Second trip, we talked about, like, what would this actually structurally look like? So very much to your point, I had said, Dave, do you know what your business is worth? He said, really kind of no idea. I said, there's a couple things you could do. You could do a simple valuation, and we have a company called Simply Business Valuations that we've used. $400, it'll give you quick and dirty. I said, it's an okay valuation if you give them good information. You could also spend probably $10,000 or more and get a really thoughtful, careful valuation. If you're just wanting the idea of, I don't know if this thing's worth 2 or 10, do the simple one. And then you've got some idea in there, but you want to know what it's worth. What I suggest to him is if he can get a seller's note and he's selling it for the price that the bank would say this is worth it, an option is something like an SBA loan, where the way I described, and I would love, maybe you're going to correct me here, he's going to get a portion of the purchase price based on that. And so say he does 75% as the SBA note. And let's say the company, for easy math, is worth $5 million, right? So 75% of it, you're going to walk away with a check. The company owes the SBA that money. The other 25% could be structured such that you've got a loan. Once the SBA is paid off, now the company is paying you off that other, I think it's $1.25 million in my example for that. So that's how I describe would be one format of saying, you're going to walk away with a large chunk of money to start with, but then you'll get paid something else later. What are your thoughts on that being an approach?
Yeah, I mean, the good thing about bringing the bank in is they're going to validate the purchase price,
Yep.
And in those situations, they might want an official real valuation as well.
Yep.
So, you got to invest a little bit in that, and maybe that's part of the closing costs, and you put that back on the buyer, that kind of a thing. Maybe you upfront the money as the seller, and then the buyer picks it up as a closing cost adjustment or whatever on their backside of the note. I would say the only thing is like the banks have gotten really squirrely lately. So back in the day, it used to be SBA would take 90-10, and you could just seller finance 10%, get a bank loan for 90, assuming the purchase price, again, assuming the business was financeable. The challenge with that now is like in the current environment, the number's more like 70-30. So I would not anticipate getting any more than 70%. From SBA, which means you're going to carry back a good sizable chunk. So again, you need to be okay with the fact that you might not get 30% of this loan. Now, that's not the plan, and obviously you'll have some safeguards in there, but the reality is if there's no money, there's no money. At some point, new person takes control, and if they sink the ship, then you're last in line. The bank's going to get their money first, to be clear. And so you're going to subordinate that note. You're going to be writing second on that. On the 70-30 split, it would give you a lot of cash down, which would be good. And then, you got to do the tax calculation. If like for him, if he has a bunch of fixed assets, you got to recapture all the depreciation. You're going to pay a higher tax rate. If he has no fixed assets, then, there's a high likelihood that he'll pay, just capital gains on the whole thing. That kind of thing depends on the type of business. So figure out the after tax money, see how all that works. But yeah, I like that process. Just know going through the SBA is arduous. Plan on that process taking 3 or 4 months. That's why you better have your books high and tight. It's going to take a little while for them to kind of get through there and make sure that everything's good. And then I would also advise, the buyer at that point, and I don't know what their financials look like, to establish a line of credit with their term loan. So they got a little bit of flexibility there whenever they come in, kind of do them as a package deal. Now, in terms of subordinating to the note of the bank, I've seen it a lot of ways. So it used to be that on that 90-10, you had to wait until 2 years for you to start making payments. Now you'd accrue interest on your note, but they weren't allowed to make payments until the end of that 2 years. Some cases I saw it where you had to wait the full 7 years or whatever the term of the loan was before you could get bought out. What I've seen increasingly more and more of is the bank doesn't necessarily care. As long as they're getting paid on a regular basis, you can start that note up right away. They can be concurrent. So I've seen less of that. It used to be almost every deal I came into, there was a covenant that said, hey, wait 24 months wait for the duration of the loan. I haven't seen that as much lately. It doesn't mean it doesn't still exist. I just haven't seen it as much.
Yeah, I'm doing one right now, and they put in the agreement that if they wanted to pay the seller note early, they could. And the SBA very quickly said, you need our permission to do that. We're not going to let you be in trouble, pay off the other guy, and then turn around and not pay us back. And so then third time we reinforced the importance of Matt really being your guy. Because I said, that means, Matt, if he's going to assume being the company owner, he's on the hook for that debt to the SBA as the owner of the company. And so you better make sure that he's really your guy and he doesn't decide to flake out in the next couple of years. You're putting a lot into that one person. So we talked a little bit about having sort of a backup plan. And then the other thing I guided him was, one reason I don't love 100% seller notes is I've seen companies when it starts getting tough, they want to renegotiate the owner or not pay them for that. And I've got one that is saying, I might just
Well,
declare bankruptcy because I think I way overpaid this guy and now I'm mad about it. And so that was one of the thoughts is why don't you do it up front, get the value. If you're going to walk away, that you've got your money up front and then it's on them to have that ownership.
100%, because they're going to do that on your 30%, but now they're doing it on
Yeah.
30%, not 100%. So
Yeah.
yes, I agree.
Yeah. Now I do think though, I think the SBA does require that if they're going to do that, that Dave, who's the current owner, is not part of the business once that transaction happens.
Yeah, there's yeah, so that's a little bit different. So
Yeah.
they'll let you like kind of wean out, but yes, there's usually a requirement that basically what they're trying to avoid is him trying to refinance his own business, suck a bunch of
Makes
money
sense.
out and still operate in own control. So he can't be an owner post transaction. He can still be an employee or a contractor for a short period of time, but he can't own anything in the company. That is true.
Yeah, that makes sense. So that got us talking about, if Matt's your guy, how are you making sure that all these customers who absolutely love Dave, they get to the point where they start calling Matt first. And for a while, Dave's there as a safety net that everyone's comfortable. But then you'd love at some point of saying they're like, Dave who, Matt's the guy who's running that company now. It used to be Dave is what you would love when you step away so that the company still is being
Preferably you do that before you enter the sale. But yeah, I mean, and that's the whole point of like prepping somebody for a sale, getting to them before they're ready to tap out. Because a lot of times that's what I'm saying. Whenever you're asking your buddy the motivation, it's like, I'm done, I'm out. So ideally you find somebody that's willing to be around for 2 to 3 years so they can stage their business correctly.
Yeah. As we wrap this up, Adam, any resources of someone saying, hey, this is great. You've given me a good overview, but I want to dive a little deeper for some topics. Anything you think of that is valuable for you?
Yeah, I mean, I think, for us in the profession, the best thing to do is like, you talked about like appraisals and stuff.
Mm-hmm.
To me, like if I want to really know how much my house is worth, I'm going to go to the realtor. You know what I mean? So I think as a professional in this space in our role, I feel like you really need to have a strong commercial lending relationship with somebody so you can like really understand like those banking mechanisms. And likewise, I would encourage somebody to establish a relationship with either an investment banker or a broker or both, preferably, so that you can understand their process and how it works. And the more you understand and have those conversations, of course, they're going to give you all the time in the world because they want you to be their salesperson, and bring clients to them. So establish those relationships. And then that way that'll help you architect how you're working with the client up front of whether or not I can qualify or bring this person to that. And then whenever you want a friend to say, in this point, whenever you're like, hey, this is how much the business is worth, you could then take it to the realtor in that situation. You could take it to the broker or the investment banker and say, hey, can you do an opinion of value on this? Like, let us know what you do taking this to market. And it might change his mind. Just to let you know, he's like convinced he wants to do it internally. He might feel otherwise based on what you tell him.
I'll take a different tag. If I'm thinking of resources, you recommended a book that I read called Exit Strategy by Adam Coffey.
Yes.
It was a really good one. He laid many of the things that we're talking about out, but he did it in a really simple way that I think if someone said, I want to be able to advise my clients, you can think through some of the terms we use, like strategic buyer versus financial buyer and second bite of the apple that we didn't talk about here, but some other things that are just really important concepts to know that if you're going to tell people, here's what the landscape looks like, I think he presents it in a way that's really good. And he talks about lots of deals that you sort of get an idea of how did this one go and what that looked like. So another place if someone's wanting to dive a little bit deeper and get some knowledge on that. Well, good. Well, thanks, Adam. Hopefully people get something from today from what would it take to help someone build a company to be more valuable, but then also what could a transaction look like? And maybe most importantly, how would we advise someone going through that kind of transaction?